Hi everybody, Philip Evanen here. Thanks for watching Whiteboard Wednesday. Today we're going to talk about wealth creation and preservation and the missing asset that most people are not aware of. There's three things that people generally want when we talk to them, and you can sort of distill down what they're looking for. Most people would like to see an increase in their wealth. These are going to seem very intuitive and very obvious, but I'm going somewhere with it. And most of us, especially successful entrepreneurs that we speak with all the time, would like to see their taxes down or have some way of reducing their tax bill. And most of us also like the idea of passing along a legacy of some sort, to family, to charity, whatever it might be. And it's really important to consider those three. Everybody I talk to has these three things in common. Now, when you think about wealth, where does it come from? Sometimes people say, well, there's lots of different ways that you can create wealth. And while I suppose that's true to an extent, I think there's only a few categories that falls into. When I look at people who really create wealth over a period of time, they don't go for gimmicky things. What they do is they buy assets. And what is one of the probably most valuable assets that we see people using to create wealth? That's business. Owning a business, operating a business, and seeing that business become profitable is one of the most effective ways and powerful ways to create wealth. But what about other ways? Well, another general category, I would say, is portfolio. So people own assets in a portfolio. Now that could be real estate, that could be a regular investment portfolio. Maybe someone might manage their own stocks, bonds, cash type of investments, whatever it might be. But it's a portfolio of assets that they've created over time, and that's another way to build wealth. Another category is registered. So I would say registered pension plan, RSPs, tax-free savings accounts. All of these things are personally held, and they could be invested in stocks. Usually they're invested in stocks, bonds, cash, maybe mutual funds, or investment portfolio of some sort. But that's a separate category. In addition to that, so you've got business assets, portfolio assets, and what I'll just call registered assets. In addition to that, you have your principal residence, maybe a cottage property, things that you own, perhaps collectibles, things that you own personally, jewelry, art, that sort of thing. But generally speaking, you're not going to sell those to derive an income. So we don't necessarily count them as assets that will help you create wealth or things you're going to live on in retirement, that sort of thing. What a lot of people do not think about is that all of these have one level or another, attract one level or another of income tax. So a business, it could be anywhere from 25 to 50%. Portfolio, it depends on what's in there. It's going to be all over the place depending on what they own in the portfolio. And registered assets, except for tax-free savings, where you've paid tax once on it and never again. RSPs, pension plans, they all attract, they're fully taxable. And so when you pull the money out, you have to pay tax $1. So it ranges anywhere from perhaps 0 for a tax-free savings account, but you're limited as to how much you can put into that, to 50% tax or more, depending on the planning that you've done and that sort of thing. Business assets are part of that. A fourth asset or fourth category, I would say, that a lot of people forget about is what I call the tax-free asset. This is especially important for business owners. So with personal money, you can create a tax-free savings account, but there's limits as to how much you can put into that. This tax-free asset is something that you can own personally or something that you can own corporately. So let's say you have a business and it's very profitable, and because it's very profitable, you set up a holding company and they're connected, and so you push profits over into your holding company, and this is really going to become what we call wealth co. So this is your investments for retirement, for the future, maybe for your family. It's money that you don't necessarily need back in the business, but you could borrow it from your holding company if you wanted to. But you've got a number of different investments in there. There might be real estate, there might be, again, portfolio assets of various sorts. What we say is what you need to consider is to have some of that money in a tax-free container within the container of that holding company. And the reason you might want to consider that is for a couple of reasons. If you're a business that is very profitable, we now know with a liberal government back in for another 4 years that we're not going to get rid of the passive income rules in a corporation. And so if you're bumping up against that $50,000 a year of passive income, you're going to start to lose your small business deduction, $5 for every $1 of earnings over that $50,000. And so anything that you can do to put money into what I call a corporate tax-free savings account is going to be helpful to you. And so we like to tell people that to create this asset, you can put unlimited amounts of money into that container within your holding company to create wealth for you and your family and your future. So don't forget about the tax-free asset. If you'd like more information, you can check our website, planwithintegrity.com, where we have a lot of other resources, and I look forward to seeing you in the next Whiteboard Wednesday.